price is falling, but something else is quietly rising. When silver crashed from $121, the fear died with it. Or so they wanted you to believe. Right now, hidden deep inside the options market, a signal is flashing that has only appeared 3 times in modern financial history, and every single time, what followed was not a crash, it was a detonation. The question is not whether you saw it coming. The question is whether you'll be ready when it arrives. Welcome to Financial Crisis Explained, the one place on the internet where the numbers speak first and opinions come last. Now, before we go any further, a humble request. You know that friend, the one you call at 2 in the morning when the market is bleeding and nobody else picks up? Be that friend to someone today. Hit that subscribe button. Pass this channel to someone who deserves to know what they are not being told. Think of it like leaving a good tip for a waiter who just saved your evening. It costs you nothing, but it means everything. And one more thing, drop a comment right now. Where in the world are you watching this from? Whether you're sipping tea in Karachi at midnight, or reading charts in London before sunrise, or catching this on your lunch break in New York, tell us where you are, because this story belongs to all of us. Now, let's begin. Silver implied volatility. Surges past level seen. When price hit $121, and most people are looking in completely the wrong direction. When silver fell, the headlines celebrated the drop. Financial anchors straightened their ties, adjusted their glasses, and told millions of viewers that the silver trade was over, that the believers were wrong, that the data had spoken. But here's what those anchors did not show you, what their producers quietly removed from the segment, what the Chiron at the bottom of the screen never once displayed. The options market told a completely different story. To understand why this matters, one must first understand what implied volatility actually represents. Price tells you where something is. Implied volatility tells you where sophisticated money expects it to go. It is not a lagging indicator. It is not a reflection of what already happened. Implied volatility is the market's internal confession, a whisper from institutions that cannot lie to their own balance sheets, even when they lie everywhere else. When silver was trading above $121 in January, implied volatility was elevated, but that made logical sense. Price was high. Momentum was visible. Attention was everywhere. Volatility rising alongside price is the expected behavior, the textbook behavior. What is happening right now is not textbook. Silver has now fallen more than 40% from that January peak. $280 billion erased from silver's market capitalization in a single session. Gold broke decisively under $5,000. $1.28 trillion wiped from combined gold and silver markets in just 6 hours. By every conventional measure, this should be a moment of calm in the options market. Price has already moved. The volatility event, according to traditional logic, should already be behind us. And yet, implied volatility is not falling. It is surging past the very levels recorded when silver was at its peak of $121. This is the anomaly. This is the signal. And this is precisely what serious decision makers cannot afford to ignore. In the professional trading world, there is a term for this specific phenomenon. It is called a volatility divergence. And it carries one singular interpretation. The market is not pricing in what already happened. It is pricing in what is about to happen. Consider what this means in practical terms. When institutional players purchase options, they are paying a premium for the right to move at a specific price point. When implied volatility rises, it means those premiums are increasing. It means sophisticated capital is willing to pay more for protection or for positioning, precisely when retail investors believe the story is over. This is not coincidence. This is architecture. Throughout financial history, the most significant price dislocations were never announced on CNBC the morning they began. They were whispered first in the options chain, in the open interest data, in the quiet accumulation patterns that most viewers never see, because most channels never show them. Right now, the BLS data is signaling monetary stress. The CFTC settlement patterns are behaving abnormally. The KOT report reveals commercial positioning that does not align with a market in surrender. And above all of it, like a lighthouse in a storm that nobody wants to acknowledge, silver implied volatility is surging, not drifting upward, not edging higher, surging, past levels that existed when silver commanded $121 per ounce. When the world was paying attention, when the trade was crowded and loud and visible, now the trade is quiet. The crowd has left. The headlines have moved on. And the signal is louder than ever. The question that every serious entrepreneur, every capital allocator, every business leader watching this must now ask themselves is not whether the data is real, The question is, who already knows what this signal means, and what are they quietly building while everyone else is watching the price fall? That answer begins in part 2. There's a rule in professional finance that almost nobody teaches in business school. When the price says one thing and the physical market says another, you do not trust the price, you trust what people are actually paying. Right now, in the Western markets, silver spot price sits at $74. Futures confirm it. Headlines repeat it. Analysts nod solemnly and type their reports. But quietly, 6,000 miles east. In Shanghai, that same silver is trading at $86, not $75, not $76, $86. A $12 premium sitting between east and west, like a fault line that nobody in mainstream finance wants to stand on top of and discuss honestly. Now here is what that $12 gap actually means, for anyone serious enough to follow the logic. In an efficient market, price differences between two exchanges for the same asset cannot survive for long. Arbitrage erases them almost instantly. Traders move capital across borders. The gap closes. This is economics 101. But this gap is not closing. It is holding. Holding firm. Even as Western paper price collapses under institutional selling pressure. Even as $1.28 trillion evaporates from combined markets in a single session. Even as headlines declare the silver trade finished, broken, over. The Shanghai premium does not care about Western headlines, and that is perhaps the most important financial sentence anyone will read today. To understand why this gap exists and refuses to close, one must understand the fundamental difference between two entirely separate markets that share the same name, but operate on completely different rules. The Western market trades paper, contracts, futures, promises. 94% of all silver traded in London and New York never results in physical delivery. It is a financial instrument dressed in the clothing of a commodity. The Eastern market trades metal, actual silver, refined, vaulted, delivered. When Shanghai prices silver at $86, that is what someone physically paid to hold actual silver in actual hands. This distinction is not academic. It is the entire story. Because what the $12 premium is telling every serious decision maker is that the physical market has quietly, professionally, and completely refused to accept Western paper pricing as reality. Think about what that means architecturally. Western institutions sell paper contracts aggressively. Price drops on Western exchanges. Retail investors panic and exit positions. Meanwhile, Eastern buyers look at that lower paper price and purchase more physical silver at what they correctly identify as a discount to true market value. The gap widens, the premium holds, and somewhere in a vault in Shanghai, the physical inventory grows quietly while Western headlines announce a crash. Now layer this against the options market data, and the picture becomes uncomfortably clear. 58,770 March silver contracts currently sit open, 294 million ounces of paper silver, with only 8 trading days remaining until first notice day on February 27th. In a normal market cycle, traders would already be rolling these contracts forward, reducing exposure, managing risk, unwinding positions. There is no mass roll, there is no panic unwind. The contracts sit, completely unmoved, like chess pieces held by a player who already knows the next 15 moves. 3 possibilities exist for why sophisticated players hold this size, this close to delivery deadline, without flinching. First, the roll is deliberately delayed to maximize pressure on short sellers who must cover or deliver. Second, certain players fully intend to stand for delivery, demanding physical silver in a market where physical premiums are already screaming shortage. Third, and perhaps most unsettling for anyone watching institutional behavior carefully, they already know something about supply that has not yet entered public pricing. The $12 gap between East and West, the unmoved open interest, the surging implied volatility. These are not 3 separate data points. They are 3 chapters of the same sentence, and that sentence is being written right now, in the only language that markets speak honestly, not in press releases, not in analyst reports, in the quiet, deliberate movement of serious money, into a position the public hasn't recognized yet. Part 3 reveals the last 3 times this exact pattern appeared in history, and what happened immediately after. Well, what 1980, 2011, and 2020 taught us about volatility spikes before major reversals. There is something deeply uncomfortable about studying financial history seriously, not because the data is complex, not because the patterns are difficult to identify, but because once you see them clearly, you realize this has all happened before, almost exactly. And the people who recognized the pattern early did not become lucky. They became generationally wealthy, while everyone else stood at the wreckage afterward, searching for someone to blame. So today, this analysis will do something most financial channels deliberately avoid. It will go back, all the way back, through 3 specific moments in silver's modern history where implied volatility surged against falling price, where paper markets screamed collapse, while physical markets whispered something entirely different, and trace precisely what happened next. Chapter 1. 1980. The Hunt brothers, the squeeze, and the signal. Nobody believed in January of 1980 silver reached $49.45 per ounce. At the time, it was the highest price ever recorded in modern silver markets. The Hunt brothers of Texas, Nelson Bunker and William Herbert, had accumulated approximately 200 million ounces of physical silver, roughly 1/3 of the entire world's non-government supply. When regulators intervened, when margin requirements were suddenly and dramatically increased, when the rules of the game were visibly changed mid-play, silver collapsed from $49 to $11 in a matter of weeks. The headlines were brutal. The narrative was simple. The silver trade was declared finished. Embarrassing. A cautionary tale for speculators. But examine the options data from that period carefully, and something extraordinary emerges. Implied volatility did not collapse with the price. It surged. Because sophisticated institutional players understood something that the headline writers did not. The physical silver that the Hunt brothers accumulated did not disappear when the paper price collapsed. It was still there, still vaulted, still real. And the entities that quietly acquired that physical inventory at $11 per ounce, during maximum public panic, during peak negative sentiment, during the exact moment when implied volatility was screaming incoming movement, those entities participated in every subsequent silver rally. For the next 4 decades. The signal was there in 1980. Most people were too frightened to read it. Chapter 2, 2011, the $49 peak, the engineered margin hike, and the accumulation nobody discussed 31 years later. History did not repeat itself exactly, but it rhymed with stunning precision. In April of 2011, silver reached $49.51 per ounce, almost identical to the 1980 peak, as if the market had a memory of its own, within weeks. The CME Group raised margin requirements 5 times in 8 trading days. Silver fell from $49 to $30 in a single month. Retail investors liquidated positions. Fund managers issued apology letters to clients. The narrative machine declared silver broken, and yet, implied volatility in silver options refused to follow price downward. It held elevated, then it surged, sending the precise signal that this analysis has been tracking. The signal that price is not the story, positioning is the story. What followed over the next 4 months was one of the most significant silver recoveries in modern market history. Silver climbed from $32 back to $49. By September of 2011, those who read the volatility signal correctly did not panic during the margin hike collapse. They recognized the engineered nature of the drop. They identified the physical accumulation happening beneath the paper noise, and they positioned accordingly, while the headlines were still publishing obituaries. Chapter 3, 2020, the pandemic crash, the volatility explosion, and the 400% move that followed March 2020. The world stopped. Silver fell to $11.64 per ounce, its lowest level in 11 years. Every conventional indicator suggested destruction. Global supply chains were fracturing. Industrial demand was collapsing. The macro environment was the most uncertain in a generation. And implied volatility exploded. Not modestly, not gradually. It reached levels not seen since the 2008 financial crisis, surging violently against a price that had already been destroyed. By August of 2020, just 5 months later, silver traded at $29.24, a 151% move from the March lows. By February 2021, silver briefly touched $30, and the Reddit-driven physical squeeze that sent premiums on American Silver Eagles to $10 over spot validated exactly what the volatility signal had been quietly announcing. 11 months earlier, physical demand was real, paper pricing was fiction, and implied volatility knew the difference long before the public did. The pattern decoded. 3 moments. 3 engineered paper price collapses. 3 surges in implied volatility against falling price. 3 periods of quiet physical accumulation by sophisticated players. 3 subsequent explosions in silver's true market value. And right now, in February of 2026, silver is down 40% from its January peak of $121. Implied volatility is surging past levels seen at that peak. Shanghai is paying $12 more per ounce than London. 294 million ounces of paper sit unmoved. 8 days from first notice day, with no panic, no roll, no unwind. The pattern is not similar to 1980, 2011, and 2020. It is identical. And if the three most significant silver dislocations in modern history, each preceded by this exact volatility anomaly, each dismissed by mainstream financial media, each followed by moves that redefine generational wealth, then the only remaining question is not whether serious decision makers should pay attention. The question is what serious decision makers should do with this information. Starting now, Part 4 builds that decision architecture. Precisely, strategically, without emotion. What serious decision makers do when volatility disconnects from price? There is a particular kind of silence that exists in the moments before major financial shifts. Not the silence of absence, not the silence of nothing happening, the silence of everyone waiting for someone else to move first. And in that silence, the most consequential financial decisions in history have quietly been made. Not by the loudest voices in the room, not by the analysts on television, not by the retail investor refreshing his portfolio app. At 2 a.m, but by the decision maker who studied the signal, understood the pattern, and built a framework. Before the movement became obvious, the framework is what this part is about. Not predictions, not guarantees, not financial advice dressed in analytical clothing. A decision architecture. The same architecture that serious institutional players, entrepreneurs who think in decades rather than quarters, and capital allocators who have studied 1980, 2011, and 2020 use when implied volatility disconnects from price direction. Pillar 1. Separating noise from signal. The first decision is always about information quality. Every major financial dislocation in modern history was preceded by an overwhelming volume of noise, contradictory headlines, conflicting analyst reports, emotional retail commentary drowning out structural data. The first decision serious players make is not about where to put capital. It is about which information deserves attention. Right now, 3 data sources are speaking with institutional clarity, while everything else generates heat without light. First, the COT report, the commitments of traders. Report published by the CFTC reveals the positioning of commercial traders, the largest and most informed participants in futures markets. When commercial short positioning remains elevated, while open interest refuses to unwind near delivery deadlines, the COT report is not showing a market in surrender. It is showing a market under deliberate pressure. Second, the options chain itself. Implied volatility is derived directly from options pricing. When serious capital purchases options at elevated premiums, it is making a calculated bet on magnitude of movement, not direction necessarily, but magnitude. A surge in implied volatility tells the informed observer that sophisticated money expects a significant price event is approaching. Third, physical premium data. The $12 gap between Western paper price and Shanghai physical is not a curiosity, it is a verdict. The physical market has ruled. That $74 Western spot does not represent true silver value. $86 Shanghai spot is the physical market's honest assessment. When these 3 sources align simultaneously, as they are aligning right now, the noise becomes irrelevant. The signal is clear. Pillar 2. Understanding asymmetric positioning, how institutions build exposure. Without announcing it, there's a concept that every serious entrepreneur, every capital allocator, every business leader managing treasury or reserves must understand deeply before this window closes. Asymmetric positioning, it means constructing exposure where the potential upside vastly outweighs the defined downside. When implied volatility surges, options premiums increase. This makes certain strategies more expensive, but it simultaneously creates specific asymmetric opportunities that did not exist when volatility was low. Consider the institutional logic currently at work. Physical silver at $74 Western spot against a Shanghai physical market paying $86 represents a 16% immediate arbitrage gap for any entity with the infrastructure to bridge east and west. More significantly, silver at 40% below its January peak of $121, with implied volatility surging past peak levels, with physical premiums holding firm, with 294 million ounces of paper approaching delivery deadline unmoved, represents a compression of risk and an expansion of potential reward that does not appear frequently in any asset class. This is precisely the asymmetric condition that institutional players construct portfolios around. Not because silver is guaranteed to move, but because the cost of being wrong is structurally limited, while the reward for being right is historically enormous. 1980 taught that lesson. 2011 confirmed it. 2020 made it undeniable. 2026 is writing the next chapter. Pillar 3, the timeline framework. 8 days, 30 days, 90 days. 3 different decisions. Not every decision maker operates on the same timeline, and serious financial architecture acknowledges this reality. The 8-day window, February 27th, is first notice day for March silver contracts, 58,170 contracts, 294 million ounces of paper, no mass roll, no visible unwind. What happens in the next 8 trading days will reveal institutional intent with unusual clarity. If significant standing for delivery occurs, the physical supply question moves from background concern to front-page reality. If a sudden mass roll occurs instead, watch the speed and pricing of that roll carefully. A panicked roll looks different from a strategic one, and the options market will reflect that difference instantly. The 30-day window. Beyond first notice day, the macro backdrop becomes increasingly relevant. Federal Reserve policy trajectory, dollar strength or weakness against Eastern currencies, any disruption to silver supply chains, from mining output to refinery capacity to shipping logistics. Each of these variables interacts with the volatility signal, creating either confirmation or contradiction of the current thesis. Serious decision makers do not make 30-day decisions on 8-day data. They build scenarios, they assign probabilities, they prepare responses. The 90-day window. This is where generational positioning lives. The entrepreneurs and capital allocators who studied 2020's volatility explosion in March and held their physical exposure through August did not do so by accident. They had a 90-day framework. They understood that compressed paper price against surging implied volatility, against strong physical premiums, does not resolve in 8 days or 30 days. It resolves when the physical market forces the paper market to reckon with reality. And that reckoning, historically, takes between 60 and 120 days from the moment the volatility signal peaks. Pillar 4, the risk framework. What serious players protect against. Before they position, no decision architecture is complete without an honest accounting of what can go wrong. Risk 1, regulatory intervention. It happened in 1980 with margin hikes. It happened in 2011 with 5 CME margin increases in 8 days. Regulatory bodies have both the authority and the historical precedent to intervene in futures markets during periods of stress. Any serious positioning framework must include a defined response to sudden regulatory action. Not panic, not exit. A predefined, emotionless protocol. Risk. 2, dollar strength continuation. Silver is priced in dollars. A sustained dollar strengthening cycle can suppress precious metals prices, even against strong physical demand fundamentals. The dollar index must be monitored, not as a primary signal, but as a modifier of timing in sizing decisions. Risk 3, Eastern premium compression. If the Shanghai premium narrows significantly, it would suggest that physical demand is softening in the world's largest silver-consuming market. This would weaken the thesis considerably. It has not happened yet, but serious frameworks monitor for it continuously. The convergence point. Every pillar of this decision architecture points toward the same convergence. A paper market under deliberate pressure, a physical market refusing to accept that pressure as reality, an options market pricing and magnitude of movement at levels that have only preceded major dislocations 3 times in modern financial history. The decision maker who waits for confirmation will find that confirmation arrives precisely when the optimal positioning window has closed. The decision maker who builds the framework now, who separates signal from noise, who understands asymmetric positioning, who operates across all 3 time horizons simultaneously, is not speculating. They are doing exactly what serious money has always done at exactly this kind of moment. The final chapter arrives next, where every signal, every pattern, every data point converges into one singular conclusion.